Good afternoon, everybody. It's July 14th. For those that don't know, every weekend I go through thousands of different stock charts just to get a good idea of things that could be added to my watch list, various sectors or industries that are performing or consolidating. Let me just say this. There are a lot of names still setting up and some hidden treasures kind of that are in the marketplace that have yet to have really any attention. So I'm going to bring some light to some of those names today. Look at during this time over here on the SPX, right? There was mayhem, there was craziness, things were going insane. And on this bounce back, a lot of people didn't believe that we can see a big bounce back, but we're there. We're at all-time highs. We're a stone's throw away from that 6,300 level. We're consolidating here sideways, taking some breath while a lot of different things set up. So in today's Stock Market Brief show, I'm going to kind of walk you through my thoughts of where we currently stand in the markets and what the expectations of the market is pricing in. Remember, this week, tomorrow, we got core inflation data. So this is going to be kind of front and center what's on everyone's mind. And I'll talk about, expectations in a little bit. But also, too, we have earnings kicking off, earnings season kicking off, and it starts off with the financial banks. So I'm going to hop right into what the banks are pricing in as far as risk. What are the options market telling us as far as expectations of risk? So these are the names from the S&P 100 that are reporting. We got BlackRock, we got BK, Wells Fargo, Citigroup, JPM reporting tomorrow. It shows your daily close and then the daily earnings expected move for tomorrow's trading session. Now, this is just probabilities, right? You have your upper level, lower level, and 2 sigma levels, and it would technically be 68% of the time we're going to be closing within this level, or at least minimum going to tag one of those levels. And then we have our 2 standard deviation moves there too. But the market's pricing in, obviously, quite a bit with these financials, which is a very heavy weight in the S&P 500. Now, given the context of earnings and earnings with banks, and then also CPI data, what is the market pricing as far as expected moves go across the board? Now, if you want these daily expected moves, I supply this every single day, trading day, to my Discord community, my Patreon, which is only $9 a month. But then also I have the Asher bot that you can run the commands and pull your levels yourself, which I'm running version 2 right now. I'm working on it to give some more added enhancements there. So if we look here at this, we're looking only at about a $39 expected move. That's plus or minus $39. That's what the market's saying is they're preparing for tomorrow's session, which honestly is not that big at all, which is kind of shocking to me to see such a small amount of risk priced in for such a big day being earnings season kickoff and also CPI. So you have your upper level, lower level, and your 2 standard deviation levels there too. You screenshot this, put the levels on your chart. I do. But let's carry on and kind of just walk you through the SPX. So the SPX has been doing what? It's been kind of this slow grind up, but for periods of times, we kind of just consolidated sideways. We squirted up higher, and now we're doing the same exact thing. We're consolidating sideways, kind of within this week's expected move, right? Today is Monday, so it's only the first trading week. We're looking at 61.70 to the lower end, 63.49 to the upper end. That's as far as risk goes. We're above the gamma flip line. So that means what? It means that dealers look to buy the dip and sell the rip. It's where volatility suppresses, which we have recently been seeing. Volatility was up a little bit today. I mean, that's pretty normal going into an event risk like earnings and also a CPI data. You have your lower monthly and your upper monthly move is there too as well. So what did I do? I applied an anchored VWAP from this kind of breakout of this sideways contraction area over here. And I'm just kind of aware that if for whatever reason the market sells off, right, and we come down into this lower weekly implied move, I'm going to be paying attention to the VWAP from here. And then also the gamma flip line in confluence with that lower weekly implied move, because this could be a level where price stalls out, but people might get a little freaked out and maybe perhaps there's more sell side or perhaps we don't even get down there. But as it stands right now, we're just kind of stalling out. And the reason for that really is the market's been mispricing risk for a couple of weeks now, right? So this prior week over here, which was 1st of July there, and the week prior leading into July, there was 2 expected moves. This is the SPY on the daily time frame, weekly basis, closed outside of the market's expectations. And now when that happens, it's just basically telling you, hey, the market is pricing in risk incorrectly, and we're kind of closing outside of what they interpret as far as risk. So now we're kind of consolidating sideways. It's very typical stuff to happen to see periods of consolidations. In my last video, we kind of walk you through the prior times that we saw two breaches back to back from the upper side. If we take a look at the SPY on the 15-minute time frame, you have your upper weekly range up here to your lower weekly range. That's about 613 to 615-ish down here. And then we have about 632 to 634 to the upside. That's weekly expectations as far as risk. And we are, we're basically slightly up on the week. Today, we started off down and then we kind of just rallied up, slow grind all the way up to the end of the day. And then tomorrow's daily ranges for the S&P 500 can bring us down to and around 619 to up here at about 630.50. We're just around those numbers overall. As it stands right now, when we look a little bit deeper into market conditions, we're above the rising 5-day moving average on all the assets here, SPY, Q, IWM, DIA, albeit this is pretty flatlined. XBI started to pick up there. We talked about on a prior episode how price was contracting there on the daily time frame, and we broke out. And then we have semiconductors. This actually should be yellow. I don't know why I put that green, but that is currently yellow because price is actually below it while it's still inclining. So if we get back above it, it'll turn green again, but at the moment it is yellow. If we take a look at net gamma, 6,300 is still that call wall, and that's pretty much where price is at. So as we had two breaches of weekly expected move and the S&P 500 has been kind of going sideways, where is it doing it at? It's doing it right at around that 6,300, which could probably be a very hard level to break if traders aren't really reaching out too much further. We can end up getting pinned and kind of float in and around that 6,300. I'm noticing this 6,500 grow in size, but that's quite a distance away here from the 6,300. Another reason probably for this stall out period of consolidation is if you look at the history chart of net gamma, we did hit a pretty high level that we haven't seen since, well, if we look back over here, it was around December. I think it was December 5th to be exact. And if you go pull up the S&P 500, what happened when we got that big of a reading on the net gamma chart, you can see that we kind of stalled out and went sideways. Yeah, obviously we went through some more volatility, but mainly speaking here, because I'm not trying to forecast this or anything, I'm just bringing up to your attention that when we hit that, we had 4, 5, 6, 7 days of consolidation before seeing a break to the downside, and or it could have very well been a break to the upside, but that's what we saw. We have a couple of assets that have been rising, such as crude oil, but today it was down, basically off the whole geopolitical risk, and then it kind of came back in. So while this is going on, we also have copper that saw a nice big breakout, and that's kind of consolidating sideways. So we have various commodities that have been doing good, which would be potentially reason why a lot of people are starting to forecast inflation to get a little bit higher of a reading. And that's kind of what consensus is saying. Core inflation, we're looking at consensus at 0.3, where the previous was 0.1. That's month over month. Core inflation year over year, they're looking at consensus is saying 3%, and that previous was 2.8. Inflation rate month over month here was 0.3. Previous, that's consensus. 0.3 is saying 0.1. And you can see the forecast over here. I believe that's Trade and Economics' forecast. Then you have your inflation rate year over year, not core. Consensus says 2.7, and then the previous was 2.4. So an uptick in inflation, which kind of then gets you into the conversation, why would the Fed cut rates? Well, we can just keep an eye on the probabilities of that here in the July meeting coming up. The probabilities of no rate cut is 95%. And if you look into the end of the year, they're still pricing in 1 and then 2 rate cuts. So if inflation remains sticky or high, what's the point for the Fed to actually reduce rates? And that has yet to be really seen. While this is all taking place, we have Bitcoin that broke out. We did have a buy signal, buy trigger after our sell signal and sell trigger. Our sell signal, sell trigger flushes down to and around 98,000-ish, and then it quickly reversed back up, giving us a positive rate of change on this tool and giving us a buy signal right over here, which shot us from about 110 and some change up to 122.5 on the Sailor to Shift tool. You can see it a little bit better here, how price got very, very tight, and then bam, we broke out. So if you're a new buyer up here, I always would wait for the consolidation. So even if we were on a sell signal, which we weren't because we went on a buy signal right here, but even if we were, the contraction is what I like the most because it offers up the best risk to reward. And when you expand it to the upside, if you're the one buying up here, people are currently selling in, you might have to deal with some consolidations. It could still obviously go higher, but after an expansion leads to typical contraction. Gold, right? We saw an expansion here. We've been contracting and going sideways for quite some time. We haven't really got through that 3,500 level, and we've just been seeing some chop back and forth overall in gold. So not much going on right there. However, silver did recently see a breakout of the 37 on some pretty strong volume, and then we kind of had a big reversal today off the highs at around 39. So watch to see how this consolidates and contracts, but also another type of asset, commodity, that I wouldn't just enter into blindly. I'd be looking to see how it consolidates, like how it did over here, right? We went through a big, nice breakout, then it consolidated for a few weeks, and then we had some follow through there. If we take a look at some of the intermarket assets, the dollar has been bouncing up, the 10-year yield's been bouncing up. So what we've been doing here on the S&P 500, it's starting to kind of flatline out. When this has been going down and the 10-year yield went down, that was a big, big move there in the SPX. So the fact that we have the dollar kind of bouncing, the 10-year yield bouncing a little bit, it's kind of stalling out the S&P 500, albeit it's still holding up rather well. If we take a look at the dollar by itself, we have a bullish divergence, and we were prepared for this, right? We said that, hey, the things can stall out a bit here, wait to see what the dollar does, and it's kind of, it's bouncing here ever so slightly, but it's still within an overall downtrend, right? Series of lower highs and lower lows. So we'll continue to just monitor that and see what happens. This chart right here, I love to kind of just reference on occasion, because you'll notice that these are just, well, let me walk you through it. This is relative strength lines, right? These are all various assets that are relatively compared to the S&P 500, but the assets that I'm using are all risk kind of safety type trades. So we have gold relative to the S&P 500, utilities, consumer staples, TLT, healthcare, and defensive names. So what I'm pointing out here really is when you see it go up like this, when they're starting to rise, this would mean you're kind of moving into a risk off environment, right? Risk off environment, meaning that these assets from a safety perspective, right, are outperforming the S&P 500. And then over here, right, over here, it's going down, which means what? It means the S&P 500 is doing good. That means risk on versus that risk off. So if I show you this on the S&P 500 chart, that is this highlighted area, right? What happened? Well, the market was going up, right? Prior to that, what market doing? Oh, it was kind of just going flatline over here. So S&P 500 was outperforming, or was kind of relatively flat. But then all of a sudden, risk assets outperformed on the way down. That makes sense. Then all of a sudden, they started going down, right? And then the EMA, right? The 50 EMA, they started trending down lower. So I'm pulling this up because we haven't really seen any sort of relief on any of these assets yet. Utilities maybe a little bit, but I'm pointing this out because also if I were to dive deeper into this and look at the absolute basis of these, there is some opportunities among some of these quote unquote more risk off type assets. Not all of them, but there are some. So I'll walk you through kind of that. Like if I'm looking at the chart of utilities from a relative basis, yeah, it's been underperforming the S&P 500, but what has it been doing? It's basically butting its head to its highs right now from a year-to-date basis. And price action is getting rather tight. It's holding above a 20-day, a 50-day, a 200-day, and the year-to-date volume weighted average price. So can there be opportunities here if we start breaking out? And would that mean that we're getting more kind of a rate-sensitive focus here on this various sector? And I think that could be a possibility. So I would say watch utilities because no one's really paying attention to it because it's been so quiet. The focus has been on like tech and higher beta names. And if I look into like one of the holdings, right, there's no particular, you can go into any of the main holdings of utilities, but one of them is Constellation Energy, ticker CEG. You can see here, what's it doing, right? You have higher lows, building next to lower highs, and price actions getting very tight above some key averages. And this right here would be, a bullish continuation pattern. And if it breaks out, maybe volatility expands to the upside, where it gives you minimal risk and potentially good upside reward. Healthcare has been a slug altogether. This is XLV, this is the spider, and it's been a slug, but I do want to call out that, hey, the 20-day is starting to kind of slope up a bit here. The 50-day is starting to flatten up. You're still below a 200-day and a year-to-date VWAP, but you are seeing a potential inverse head and shoulders build out for, whatever you want to count that as. But basically, in my opinion, you'd still want to tighten up and get back above the year-to-date VWAP. I did share a chart not too long ago. This is in the S&P 500 DHR, and you can see here that price action is just coiling up very tight right at around that year-to-date VWAP. It actually came up, got rejected, came up, got rejected, came up, got rejected, started to break out, and then got rejected today. So it's overall coiling up. I'd be more bullish, obviously, on a breakout, and then it gives you that better risk. But if it breaks down, watch out, because we could expand. Volatility can expand, and that could bring the price to the downside. Energy has also been a sector to really kind of keep a close eye on. And the reason for that is from an intermarket perspective, when energy outperforms the S&P 500, that typically means that the S&P 500 has pressure to the downside. And it could be from a cycle basis, energy being a top performer can tell us when a market is kind of topping, actually. I'd have to show that chart, but I don't have it with me. I've shared it many times on this channel. But XLE, it's been just putting in some higher lows you might want to pay attention to. It's trading at around a flat 200-day, rising 20, rising 50, and above a year-to-date VWAP. One of the holdings is XOM, and you can see XOM has those lower highs, and you have some higher lows over here. So if this starts to break out, perhaps you get some sort of interest in some various energy stocks that we haven't quite seen for a little bit of time here. Real estate, another rate sensitive sector, getting very tight. Ain't nobody talking about really real estate right now. That makes, sense to me because, well, the equities itself or the ETFs, they haven't really been doing much other than getting tight. And remember, one of the basic principles of technical analysis is markets move between expansion and then contraction. And then once they contract, they expand again. So I'd be watching for a potential breakout in real estate. If it breaks down, I'm not interested. I do have a position in some real estate names. I took a position in Well. This is a REIT. It's Welltower REIT. And you could see it kind of butted up its head on this pivot line multiple times, but we've been putting in higher lows, and then I started building in a position, and it broke out these last couple of days to the upside. So we'll see if we get some sort of continuation. Just be mindful that you do have earnings right around the corner. CCI, Crown Castle REIT, was brought to my attention on a live stream by one of the viewers at the time, and when I pulled up the chart, I was like, wow, yeah, that's a great chart. Thanks for sharing it, because you do have price action coiling up very, very tight. For those kind of dividend type investors, there's a pretty good dividend associated with Crown Castle too. All the moving averages are kind of converging here, and you're holding above the year-to-date VWAP. You do have earnings right around the corner. I see pockets of some really good kind of volume in here on the green days, so that's positive to see. So I do have a subtle position in here, small, but if we break through 105, maybe that gives us that expansion in price to 110, 115, potentially even more. Another sector that's been doing good is materials, and that one's been kind of consolidating, and one of the names that kind of popped up on my radar was MLM. And I just kind of like how this is setting up from kind of a cupping standpoint, kind of getting tight here, where we're kind of just butting our head on the pivot from the year-to-date high. So this one looks pretty nice. I'd like to see some more consolidation, but a break through this could lead to a continuation as well. VMC is another material name. I think this was a material name, or maybe this was an industrial. I'm pretty sure it was a material name, but VMC also could have been an early entry for those that were paying attention. Over here, I did get an early entry. It's above a 50, 20, 200-day and the year-to-date VWAP. But the main pivot is more up here to 280, where we've been kind of running in to supply multiple times. So if we come back up here, maybe doodle around, tighten back up, this could be another name to just secretly keep there on that radar. Another name is Olli, O-L-L-I. This one broke out on some good volume and recently has just been consolidating sideways. This one falls within, this is a bargain outlet. This falls within, I believe, consumer discretionary and not consumer staples. I guess it would depend on what platform is kind of putting it in what category, but from what I saw on Thinkorswim, it said consumer discretionary. And that's really all the charts I got for you on today's episode. If you want like more charts and more setups like this from a weekly basis, I do have the Discord or the Patreon. Just go and sign up for Patreon, sync your Discord. You get access every week to that, plus amongst a bunch of different benefits. Like I said, there's a lot of different names that are setting up here from kind of like a hidden treasure perspective where things are contracting, people aren't really talking about. And yeah, I think you just got to really keep your eyes peeled because the market right now, it's right around all-time highs. If we start getting rotations, yeah, perhaps the market comes in a bit. You get some focus off of some of the bigger tech stocks that ran up, but perhaps then you get a rotation into the names that have been quiet, like some of the names that maybe I shared with you today. All right, see you later.